Good afternoon, everybody. As indicated, I'm Douglas Radcliffe, and I'm the Group Investor Relations Director for Lloyds. Sarah has been in my team for a little while now, so welcome on board, Sarah. We're really happy to be running another one of these briefings with ShareSoc. We view these events as an important way of actually keeping in touch with our retail shareholders, so thank you for joining us. During the presentation today, I will talk to our strategy, in particular our outlook to 2026, and Sarah will talk to the latest financials, including our half-year results, which we released in July. We're intentionally using some of the slides from our half-year results so you can see what we presented to institutional investors at the time. The presentation should take about 20 minutes, and we will then leave plenty of time for Q&A at the end. With that, let's move on to the first slide. As many of you will know, Lloyds is a UK-focused retail and commercial bank. We have a simple operating model with the business split across three reporting divisions as outlined on the slide here: retail banking, commercial banking, and insurance, pensions and investments. Within these divisions, our customers are supported by a comprehensive product suite. This scale is underpinned by a portfolio of familiar and trusted brands such as Lloyds Bank, Halifax, and Scottish Widows, alongside a few newer brands you may be less familiar with, including Tusker, our car salary sacrifice proposition for corporates, and Lloyds Living, our private rental arm. The breadth of our franchise provides us with a key advantage in servicing more of our customers' needs, as well as understanding them better, to provide more targeted offerings that deliver value for both customers and the group. As ever, we are guided by our purpose of helping Britain prosper. I'll now go on to our competitive strengths, which differentiate our proposition on slide 4. As many of you will be aware, we're the biggest UK bank with 900 billion of assets and 28 million customers. This gives us extensive reach across the UK. We are also the number one provider in several of our core product areas, including mortgages, cards, loans, and transport. Our capabilities across both banking and insurance are unique within the UK and offer a clear competitive advantage. We also have a strategic vision of being a UK customer-focused digital leader. We now have around 21 million mobile app customers, and we are continually leveraging these digital strengths to innovate and improve our customer products and services. We see leadership in this digital area as being critical to long-term success, linked to our track record of investment in digital, AI, and data. This enables us to innovate, to anticipate and meet customers' ever-evolving financial needs. I'll now provide an overview of our strategic focus areas on the next slide. In February of 2022, you may recollect that our CEO, Charlie Nunn, set out a 5-year strategy for Lloyds Banking Group. This strategy focused on driving revenue growth and diversification, strengthening our cost and capital efficiency, and maximising the potential of people, technology, and data. Our revenue growth initiatives are focused on 4 key areas: deepening and innovating within the consumer space, creating a new mass affluent offering, building our corporate and institutional offering, and digitising and diversifying our SME business. If you want any more detail on these initiatives, please do look at our website, as we've done separate strategic seminars for each of these areas over the past couple of years. We are now close to the end of the 4th year of our 5-year strategy and are on track to deliver our 2026 targets, including over 1.5 billion of additional revenues from strategic initiatives by 2026, with over 1 billion delivered to date on an annualised basis. We also continue to focus on increasing productivity and have delivered around 1.5 billion of gross cost savings since 2021. Our strategic delivery reinforces our confidence in meeting our 2026 financial targets, which I shall now turn to. As said, we are confident in meeting our 2026 financial commitments with significant operating leverage supporting our guidance of a cost-income ratio below 50%, a return on tangible equity of greater than 15%, and capital generation of greater than 200 basis points. On the final slide of this strategy section of the presentation, I'll provide a few examples of how we are successfully delivering our strategy in the first half of 2025. We continue to build a highly differentiated franchise. For example, we've continued to take a leading role in supporting the critically important housing sector, lending more than 8 billion to first-time buyers and supporting over 1 billion of funding to the social housing sector in the first half. At the same time, we are delivering growth through our strategic initiatives in a number of areas. This includes significantly increasing our penetration of protection products for mortgage customers and gaining share in sterling interest rate swaps in the commercial side. This business momentum is underpinning our sustained strength in financial performance in the first half of the year, which Sarah will now provide an overview of.
Thanks, Douglas. As said, Lloyds Banking Group demonstrated sustained strength in financial performance during the first 6 months of the year. Statutory profit after tax in the first half was 2.5 billion, with a return on tangible equity of 14.1%. Net income of 8.9 billion was 6% higher than the prior year. This was driven by continued momentum in net interest income, alongside 9% year-on-year growth in other operating income. H1 operating costs of 4.9 billion were up 4% year-on-year, in line with our expectations. Asset quality remains robust. The H1 impairment charge of 442 million equates to an asset quality ratio of 19 basis points. Our performance resulted in strong capital generation of 86 basis points in the first half. This supports our 15% increase in the interim dividend. I'll now turn to slide 9 to look at developments in our customer franchise. Our customer balances showed good growth in the first 6 months across both lending and deposits. Group lending balances of 471 billion were up 3%, or 11.9 billion, since the start of 2025. This growth was largely driven by mortgages, up 5.6 billion in H1 and 0.8 billion in Q2. This is as a result of a healthy underlying market demand, as well as our strategic initiatives in this area. Elsewhere in retail, we've also seen growth in unsecured loans, credit cards, and motor finance. Then in commercial banking, lending balances also grew by 1.2 billion in H1, including 0.9 billion in Q2. In particular, we saw growth in infrastructure lending within our corporate and institutional business. We have also grown deposits by 2%, or 11.2 billion this year so far. This comprised 3.7 billion in retail, driven by inflows to savings accounts and as a result of a very strong performance throughout the ISA season in Q2, with over 375,000 cash ISA accounts opened. Commercial deposits increased by 7.6 billion in H1, including 5.3 billion in Q2. This is driven by growth in targeted sectors. So now turning to net interest income on the next slide. Net interest income was 6.7 billion in H1, so up 5% year-on-year. NII continues to be supported by positive momentum in the net interest margin, with the Q2 margin of 304 basis points up slightly on Q1. NII was further supported by average interest earning assets of 460 billion in Q2, which was up 4.5 billion versus Q1. So looking ahead, we continue to expect net interest income for 2025 to be circa 13.5 billion, and that's up around 700 million from last year. This is built on further lending and deposit growth, as well as a significant pickup in the income from the structural hedge. Indeed, actually, hedge income is expected to grow by 1.2 billion in 2025, and then a further 1.5 billion on top of that in 2026. I'll now talk to continued momentum in other income across the franchise on the next slide. So other income of 3 billion in the first half was up 9% on H1 last year. This included 1.5 billion in Q2, also up 9% year on year. This growth is driven by broad-based momentum across the business, linked to our strategic initiatives. Within retail, 13% growth versus the prior year was supported by higher income from personal current accounts and also continued strength in our motor leasing business. In commercial, year-on-year strength in transaction banking income was offset by lower loan markets activity. And then insurance, pensions and investments delivered a strong performance, up 6% year-on-year. General insurance did particularly well within this, with income net of claims up 35%. Then finally, in equity investments, Lloyds Living is developing well, with income up 19% year-on-year, alongside growth in LDC, which is our private equity arm. Looking forward, we continue to expect ongoing growth in other income, linked to both BAU growth and also strategic initiatives. Then turning briefly to operating lease depreciation, which is the depreciation charge for our operating lease business, that was 710 million in H1. And we continue to expect this operating lease depreciation charge to grow in line with profitable fleet growth and higher value vehicles going forward, with volatility in the charge mitigated by a number of strategic actions that we've implemented this year. I'll now turn to costs on the next slide. So we remain very committed to cost discipline. H1 operating costs were 4.9 billion, up 4% year on year, or actually up 2% excluding some front-loaded severance charges that we took in Q1, and those were taken to accelerate efficiencies. So overall, operating costs are tracking in line with full-year expectations, with business growth and inflationary impacts, including national insurance, partially mitigated by savings driven from our strategic investment. Looking ahead, we continue to expect operating costs of circa 9.7 billion for the full year. Remediation remains low at 37 million, and there was no further charge for motor finance in the first half. And I'll actually cover motor finance specifically in more detail on the next slide. So our provision for potential remediation costs relating to motor commissions stands at 1.15 billion. The provision is based on a range of probability-weighted scenarios to address uncertainties around a number of assumptions. So I'm sure many of you will have followed the Supreme Court judgment on the 1st of August in respect of Wrench, Johnson and Hopcroft. That judgment overturned the Court of Appeal's decision in relation to fiduciary duties and bribery and upheld an unfair relationship claim in the case of Mr. Johnson. So whilst this judgment clearly provides additional clarity, there remain a number of uncertainties. So the FCA will publish a consultation on an industry-wide redress scheme by early October. This means the ultimate impact on the group will be determined by a number of factors still to be resolved, particularly the outcome of the FCA consultation. However, after initial assessment of the judgment, the group currently believes that if there is any change to the provision, it is unlikely to be material in the context of the group. Clearly, we will continue to review any further information and update as and when necessary. I'll now turn to asset quality on the next slide. Asset quality remains robust. The H1 impairment charge of 442 million equates to an asset quality ratio of 19 basis points. This reflects stable credit quality during the period, with either stable or improving trends seen across our portfolios. Similarly, early warning indicators remain low and stable. We're very confident in the balance sheet given our prime customer base and a prudent approach to risk, and we continue to expect the asset quality ratio to be circa 25 basis points for the full year. I'll now hand back to Douglas to cover capital distributions and wrap up the presentation.
Thank you, Sarah. So, on the next slide, as you can see, capital generation of 86 basis points was strong in the first half of the year. This supported sustained growth in shareholder distributions. Indeed, at the half year, we announced an interim dividend of 1.22 pence per share, up 15% on last year. As usual, we will consider further capital distributions at the year end. Dividends per share have grown consistently over our strategic plan, now up more than 80% versus 2021. Alongside this, we have undertaken consecutive and significant share buyback programs. These have reduced the group share count by circa 16% since the end of 2021, supporting growth in value for our shareholders. I'll now wrap up on the final slide. In summary, the group is showing sustained strength and delivering in line with expectations. In the first 6 months of the year, we saw continued growth in net income, cost discipline, and robust asset quality, driving strong capital generation and an increased interim dividend. Looking forward, and based on this sustained strength, we feel very comfortable with our 2025 guidance and remain confident in our 2026 commitments. Both are set out in full on the slide. I hope you found this to be a useful and interesting update. To summarise, we're very pleased with the progress so far and are excited about the opportunity to accelerate as we deliver our highly compelling investment case. So it looks as though that's now taken up about 20 minutes, as expected. So we'll now open up the call to Q&A. There is the ability on the actual drive to submit your questions. We will then subsequently just go through each of the slides, each of the questions as they come through and add further detail. I think it probably makes sense for us to kick right into the questions. So the first question that came through has actually come through about recent press articles about the unhappiness within the workforce by some of the measures taken as part of maximising potential of people. The question was really being, what actions are being taken to ensure you obtain and retain the best talent to ensure success in the future? So obviously this is an interesting question. There's obviously been an element of speculation in the press with regard to performance management within Lloyds and how we look at structured support as a whole. In essence, this is actually very similar to the way many good organisations around the world actually manage performance. And actually, it's not something particularly new to the organisation. Essentially, we want Lloyds to be a high-performing organisation. You, as shareholders, I suspect, also want us to be a high-performing organisation, and our customers, clients, and stakeholders all expect that of us. So basically, what we're trying to do at all times is actually ensure colleagues can achieve what they're capable of in our business. And to do that, we just have to be honest with those that need to contribute more, and we have to make space for those with potential to progress and grow. So really, what I would say is, the press speculation that you've read about is really about having an effective performance management approach within an organisation, and actually, that's the right thing for any successful organisation. I think that probably covered that question. Another question was, how should we think about the future mix of dividends and buybacks in your distributions, please? That's a really important question and one that we're frequently asked, not just by retail shareholders, but also by institutional shareholders. Our approach has actually been relatively, or very consistent, in fact, over recent years. We have a progressive and sustainable ordinary dividend policy. That progressive and sustainable ordinary dividend, you'll see that that's been reflected in the increase in ordinary dividend by 15% at the half year. In essence, from our perspective, our belief is that we can continue to deliver that progressive and sustainable ordinary dividend over a number of years. In addition to that, what we look towards doing is actually paying out excess capital to shareholders at the end of each year. In recent years, that's been undertaken through a buyback. Last year, it was 1.7 billion. The year before that, it was 2 billion. So you should fully expect the board to continue to consider excess capital repayments at the end of each year. What's really important, I suppose, is what it really means for, or how you then contextualize what the level of that ordinary dividend is and what the level of the buyback is. And that's why we give the guidance around the capital generation. We've talked about delivering 175 basis points of capital generation this year. We've talked about delivering more than 200 basis points of capital next year. The other aspect that indicates almost like how much capital will actually pay out at the end of the year is the capital ratio that we pay down to. You'll see that we've indicated that we will pay down to a 13% CET1 ratio by the end of 2026. We paid down to 13.5% by the end of last year, and we've indicated that there will be a journey to move towards the 13%. So you should fully expect us to pay down somewhere between the 13 and the 13.5% at the end of this year. So actually, when you look at our approach to mix of dividends and buybacks, that's the way to look at it. What I would say is on the excess capital repatriation is that we're constantly looking, and the board looks at what the most effective way to return excess capital is. In recent years, we've very much believed that buybacks is the best way to do that. Clearly, that's something we'll consider as the share price has recovered, as our valuation versus our tangible net asset value has recovered. But certainly when we speak to retail shareholders, when we talk to institutional investors, the current view is, given the significant value that both the market and we believe is still available, the view is still that I think that buybacks are the favoured approach. But we continue to listen to all investors to see exactly what the right approach should be going forward.
I can do the pref share one.
Go on then.
Yeah. So there's a question. You bought back some of your preference shares in 2024, but at the end of last year, you still had 5 class in issue, some with very high coupons. Over time, should we expect that you'll retire more of the preference share, please? So we've got 4 preference shares outstanding at the moment. So 2 a GBP, 2 a US dollar. We don't actually disclose whether we intend to redeem outstanding instruments in the future. It's very much considered on a case-by-case basis at the time. As you can imagine, we'll take into account a variety of economic, regulatory, legal and practical considerations. But we do continually monitor the market for any opportunities to repurchase or exchange those remaining preference shares outstanding. So we will see.
Okay. Another question has come in, which is unsurprisingly about the economic environment and how we see almost like earnings progressing given a lower rate environment. It's really quite interesting at the moment because people talk about the UK economy and the environment as it stands at the moment. And actually, the environment as it stands, although it may not be necessarily exciting, isn't actually unsupportive to Lloyds Banking Group and how we operate. Certainly, if you get to the stage where rates are where they are at the moment, there's certainly much more of an ability to manage both the asset and the liability perspective. If you actually look at our economic expectations, and we're one of the few banks that actually update our economic expectations every quarter. You can see them in the slides, you can see them in the news release when we actually produce our results. And actually, what you see is our current projections are probably GDP growth of about 1%, both this year and next year. you're probably looking at unemployment peaking at about 5% next year, and you're looking at slight growth in house prices. The other area that was specifically referenced in the slides was actually the base rate. At the half year, we were actually expecting a couple of reductions in the base rate over the second half of the year. Clearly, if you look at the market and the market environment, I think the general expectation would be that would be less than that now, but we will look towards updating those expectations as we move forward and when we issue our Q3 results at the end of October. The question, though, I suppose, was really there is, irrespective of the resilience of the UK economy, what does it mean from our net interest margin going forward, even though the rates are reducing? Now, in essence, I think when you look at our net interest margin and our net interest income, there are three primary factors that are probably influencing net interest income going forward over the short to medium term. One of which is very much a tailwind is structural hedge earnings. When you look at it from a structural hedge perspective, we have about 244 billion under investment. Effectively, those are interest rate insensitive balances. They've got a weighted average life of about 3.5 years. So in theory, they would roll off over a 7-year period, being a weighted average life of 3.5 years. But essentially, what you'll see at the moment is that structural hedge is actually earning probably about 2.2%. But actually, as you reinvest those funds each year, they're actually reinvested into a market that's earning more like about 3.5% to 4%. So you can see that at the moment, you're actually getting a benefit as you reinvest that 30 to 40 billion of maturities each year in the structural hedge. So that's very much a tailwind. That's slightly offset by a couple of headwinds, one of which is mortgage repricing. Effectively, if you look at it from a mortgage side, the current completion rate for mortgages is probably around 75 basis points. If you look at mortgages and the rate that they were written, probably about during COVID and the like, it was significantly higher than that. So effectively, we've got business that's coming off quite high rates, going on to lower rates, and that's been occurring over the last 3, 4, 5 years. In essence, that is a slight headwind when it comes to both net interest margin and net interest income. At the same time, what you've got is effectively deposit migration, which is effectively current account balances moving to savings accounts, where essentially the rate that's achieved is actually, or the margin that's achieved is less, because obviously the rate payable to customers is higher on savings balances. So that actually becomes effectively a headwind as well. But basically the tailwind of the structural hedge more than offsets the benefit that's coming from those two headwinds. Hence why we expect the net interest margin to increase this year. We haven't actually given effectively guidance beyond that for net interest income or indeed net interest margin, but you can see that the positive trends in those areas are very much driving the increased return on tangible equity. From a return on tangible equity perspective, we're expecting greater than 15% next year, and indeed the capital generation, which we're expecting to increase from around 175 basis points to more than 200 basis points. So we're still very much of the belief that actually we can still see positive momentum in the net interest margin, despite the fact that the base rate is falling.
Shall I do the M&A one?
Yes, that makes sense.
Yeah. So the question is, are there any gaps in your product set that you'd like to close through M&A? You've made some interesting acquisitions in recent years that have added capabilities. Yeah. So in terms of M&A, first and foremost, our strategy is an organic one. So when we set out our strategy in February 2022, if you think about the scale of Lloyds Banking Group and the fact that we are already kind of number one market share in a lot of our key product areas, for us, any M&A is really kind of small and around the edges, where we see opportunities to improve the customer journey or a customer offering that is easy to acquire versus us doing it kind of organically and building it in-house. So when you think about the examples of acquisitions that we've made over the past couple of years, Tusker, our car salary sacrifice proposition, springs to mind, as does Embark, which is a share investment platform. So the two of those are very much kind of small, and in terms of capital, it didn't make a lot of impact. But we do look at all of these things in the round. So when you read on the news about X bank buying X portfolio, etc., they're always things that we will have looked at, but we will have decided for one reason or another that it didn't make sense for us from a kind of a proposition perspective. So we'll look at all these things in the round. I'd say from our kind of product set, there's nothing kind of in particular that we'd kind of call out at the moment, but we will obviously look at all of these things very actively as and when they come up for sale or acquisition.
And I think actually linked to that, Sarah, is actually one of the areas that's also touched upon in another question. One of the other questions was talking about the profits associated from ending the AG Bell partnership in regard to SIP management and bringing it in-house. I'm not going to talk about individual profitability or different areas like that, but what I would say is that one of the strategic areas of focus for us as an organisation is very much, almost like the mass affluent and the wealth franchise. From our side, there's very much an area here that, their customers in that mass affluent have not been able to access investment management in the same way that I think both from a Lloyds perspective, we would like customers to be able to access, and indeed from a regulatory perspective. And a lot of that is effectively from previous regulation that actually meant advice is only really available to those that have got much larger amounts of money. So it's one of the things that we're trying to look at from a mass affluent side. And one of the areas you'll see how that's actually developed in the last year or so is when you look at our representation in ISAs. If you look at it from an equity ISA perspective, I believe over the last 12 months, we're actually almost like the number one or number two provider. And actually that's a significant increase from where we were 2, 3, 4 years ago. And it's a big area of focus about how we look at basically that mass affluent proposition and really ensuring that we've got everything available from execution only share dealing all the way through to direct access to investments, to advisory services. And that's very much where we believe Lloyds can act as a unique provider in the UK market with both a banking proposition and indeed an insurance proposition available through Scottish Widows. So that's very much the way that we're looking at trying to enable that. And one of the reasons that we think that that's going to be more successful going forward is actually from a digital side. It's not just the change in regulation that we've seen, but it's also when you look at it from a digital side, the significant investment that's gone into the app is really making a difference from this side. A number of you may well be banking clients of Lloyds, and you can now see that actually on your banking app, you can not only access your current account, your savings account, but you can also access elements of Halifax Share Dealing Limited, so the execution only share dealing service. There are also elements how some people are now able to access their pensions through Scottish Widows through that as well, and indeed look at other products such as general insurance that are all available and can be reviewed on the app. So I think that whole digital development and investment that's been made really provides a significant differential in the way that people look at the almost like the more holistic banking proposition going forward.
Then there's a question around what's happening to loan quality and defaults at present. So as I kind of touched on in the slides, asset quality has been very robust, reflecting both the fact that we've got a very prudent lending book, but also we're seeing very healthy customer behaviours in terms of customers paying off their credit card balances at the end of the month, customers having a relatively prudent approach to lending as well. So what we're actually seeing both on the retail side and the commercial side is that new to arrears are low and are either stable or falling across all the portfolios. And similarly, from an early warning indicator side, whether that be minimum repayment levels in cards are very low and stable. And similarly, on the commercial side, we're seeing things like working capital utilization levels being very low. So what does that mean? Corporate clients aren't drawing down the whole extent of their RCF. They're able to meet their day-to-day payment needs using their own kind of working capital. So what did that mean? To asset quality ratio was only 19 basis points for the first half. It was actually only 11 basis points in Q2. So well within our 25 basis point guidance for 2025. So we feel very, very comfortable with asset quality in general.
Yeah, and I think just adding to that, I mean, I think that robust asset quality, which I say is driven by not just the prudent approach to risk that Lloyds has taken over the last few years, but also the economic environment. And the economic environment, as I said earlier, is actually not unsupportive. Given the fact that although you have GDP growth, which is relatively low, it's actually quite steady. And I think that relates to another one of the questions about actually where we expect interest rates to go to. One of the questions outstanding was, at what level are Lloyds expecting interest rates to bottom out? Well, we're probably expecting interest rates to bottom out at the moment, probably around the 3.5% level, somewhere like that. Obviously, rates at the moment are at 4%. Clearly, we'll have to see how things progress and how things change. But I think that sort of level is broadly where our expectations lie. What I would say is, at that sort of level, effectively customers have seen that actually, they're really quite resilient. There was a little bit of a concern in the UK as mortgages repriced and as rates were rising and they increased, whether customers would be able to afford their mortgage repayments, but or the increases in mortgage repayments. But actually what we've seen is actually the customers have been really remarkably resilient, and actually at the same time savings balances have increased, not just on the commercial side, but also with retail customers. So I think actually that the overall economic environment is actually quite good for credit at the moment as well.
And then there's another question on how resilient is the bank to a cybersecurity attack? So from our side, this is an area where we place a huge amount of investment every year. So if you think about group costs, and as you can imagine, there are always kind of prioritization exercises that we go through. But from a kind of cybersecurity perspective, that is always something where a lot of focus is placed and a lot of investment. And actually, we've been very resilient to kind of cyber attacks. In general. And I'd say that kind of linked to that, and there's another question around digitization. When you think about the investment spend that Lloyds has made over the past few years, 3 billion over 3 years, 4 billion over 5 years, a lot of that has been in technology and also in cyber, and that's starting to have a positive impact from an efficiency perspective and on cost to serve and cost to acquire retail customers. So I think we gave stats around reduced cost to serve with our full year 24 results. We also said at the half year that actually the strategy and our kind of strategic initiatives have generated 1.5 billion of gross cost savings so far as a result of the strategy. And we continue to see further opportunities to reduce manual back office processes, from a finance perspective, from a risk perspective, from a retail perspective. You continue to see kind of branch closures and using digitization to really improve the kind of cost to serve and also improve the customer journeys as well, as Douglas was saying, in terms of building things into the app. From an SME perspective, we've considerably improved our mobile onboarding capabilities. So as you can imagine, it used to be a very manual process for a business banking customer to be onboarded, lots of kind of forms going through the post, but now it's done from a mobile perspective much quicker and much easier. So that's really an area where we feel really pleased with the progress that we're making on the kind of tech and digital side. And actually, we're going to be doing a specific investor seminar later after our Q3 results, so in November, on digital and AI, and how we are using both of those to drive a kind of competitive advantage and the opportunities that we see in the future.
Yeah, and I suppose linked to that as well, I mean, both on the cost to acquire, is really how fundamentally you look at the cost income ratio for the group as a whole. We probably had for the first half of the year, we had a cost income ratio of about 55%. We very much believe that there is an opportunity to reduce that. Indeed, one of our core areas of guidance for 2026 is actually a cost income ratio of less than 50%. So you can see there that clearly, we're very much targeting, further improvement during the course of this year and indeed into next year. And that improvement, I think, is very much from both sides. It's both from, clearly, the clue is in the title with the cost income ratio, but, that's from both increasing income and very much control over costs. And, that's really, fundamental to the way that, Lloyds as a group operates. Cost is very much a competitive advantage and will continue to be a competitive advantage, as we continue to progress, not just this year, but going forward, and as we continue to invest in the business. So I think that whole digitalization and investment will be fundamental, but is very much a priority for us. There's another question which sort of relates to one of the questions I was talking about earlier, which was really about what's your buyback policy from here going forward. So I touched upon that a little bit earlier. So effectively, we have the progressive and sustainable ordinary dividend. That's very much our approach. And effectively, what we'll do is we'll then look at the board tends to look at the excess capital repatriation at the end of each year, and the board makes those decisions at that point in time. What I would be very clear about is the fact that actually the board has made it very clear that returning capital to shareholders is a priority. Now, how that's done, we've been very clear with the progressive and sustainable ordinary dividend. The excess capital repatriation decision is made at the end of each year. The current view is that actually the buyback or undertaking a buyback is the best approach to do that, but that's reviewed each year. Clearly, there are alternatives. You could undertake a special dividend, you might, or a buyback. Alternatively, you could actually use those funds either for M&A or indeed for further investments. But our view is that we're already making a significant amount of investment, prior to actually almost like announcing our capital generation of the around 175 basis points this year, the greater than 200 basis points next year. It will continue to be important, but it's how you repatriate that. And as Sarah mentioned earlier when she was talking about M&A, look, our strategy is very much an organic strategy. It's very much looked at value for the organisation. Any potential acquisitions have to be aligned from a strategic perspective. They have to be aligned from a risk perspective, and they have to deliver value. So from our perspective, there's nothing significant on the agenda at this moment in time. But naturally, as one of the largest financial providers in the UK, it's right for us to consider those options. But I think from a perspective at the moment on buyback is our current approach to returning excess capital, but that decision is reviewed at the end of each year.
There's a couple of questions around share dealing, and in particular, what we are doing to encourage individuals to invest more of their cash rather than saving it. So I think from our perspective, I'd call out two things. So firstly, around 18 months ago, we launched something called Ready-Made Investments within our app. This is a very kind of simple, easy investment tool where effectively you can put in the amount that you want to invest, your risk appetite, so kind of low, medium, high, and the tool will then recommend you an ETF type product. So that's kind of the first thing that we're doing, seeing kind of good take up there. Clearly, we would also say that if people want to use their money for savings, we've also got a vast range of savings products. So we've got products for all different types of risk appetites and also different kind of macro environments. So clearly what I'd say over the past few years is, because interest rates have been so high, the rates that you can get on term deposits have also been very high, and that has prompted customers to move their money into savings rather than investments. However, there's reason to believe that as and when rates come down, those investment products become more attractive, and so we've been building the ready-made investment products as well. What we are also doing, kind of linked to our mass affluent proposition, is also working with the FCA in a kind of a sandbox environment to look at AI-driven kind of money management tools, and whether there's more that we can do in that space, kind of particularly linked to investments as well as savings products. So it's definitely an area that we're very much focused on. And as Douglas said, we've significantly increased our market share in stocks and shares ISAs. So we were probably about 5% market share a few years ago, and now from a flow perspective, so flow like new ISAs this and last year, it's been much more like 20%. So it's very much an area of focus.
Yeah, and that's very much reflective of the investment that's being made in that area, and will continue to be made, because we do feel with the customer franchise that we have, that we should be able to meet those customer requirements, those customer needs, through the services that we provide. Another question that actually, which is probably just more a general question, is what's the best way to register for these digital seminars? So a couple of things that I would say is, first of all, on the investor relations website, you can actually see the seminars that we've already undertaken. We've already undertaken seminars for effectively, the 4 divisions that we were looking at from a strategic perspective. So you can actually see business updates from effectively the divisional executive teams, along with Charlie, and it provides a good overview of both the strategic priorities and progress being made for each of those divisions. As Sarah indicated, we're going to be undertaking another one on digital and AI, which is, the actual data is yet to be formalised, but it was probably likely to be probably it will be after the Q3 results, so before the end of the year. We will be announcing, the formal dates. That will probably be whether we do that pre-Q3 or at Q3. But all the detail will be available on our website, and indeed you'll probably be able to watch it on the website as well. We normally do it as a live webinar, so through the investor relations area of lloydsbankinggroup.com. There's another question, which is always an interesting question from an IR perspective, which is asking me whether I feel that the current share price is an undervaluation. Asking that of an IR team is always clearly a one-sided view. But I think what I would say there is that actually you can see currently where we are delivering for 2025. You can see that, so you look at the returns. I think we had a return on tangible equity of 14.1% at the first half of the year. You can see that we are expecting to deliver 175 basis points of capital generation this year, and actually we're well on track to do that. But fundamentally, what I would say is actually our guidance for return on tangible equity next year is greater than 15%. So you can see the trajectory that we're expecting from a return on tangible equity perspective. You can see that the trajectory that we're expecting from a capital generation perspective as well. And you can see the trajectory that we're expecting when it comes to the cost income ratio as well. So, our view is very much that, if we can deliver against that guidance, that should continue to be recognised in the share price.
And then kind of finally, we've got a question around digitisation. So overall as a population, where are your retail customers on the digitisation journey, where 0 is no engagement, 100 is full engagement, where all processes are digital? What I would say is that clearly there's a range, as you would expect there to be. We've got 28 million customers and 22 million mobile app users. So that indicates that a good proportion of our customers are very much digital and using our app on a kind of daily basis. We've got about 7 billion logons a year onto our mobile app. So really kind of considerably used app, which is really important for us as it enables us to build better relationships with customers. However, clearly there are some customers who are not digitally active, and that's why we've still got we're the largest branch provider in the UK, with around kind of 1,000 branches still remaining. So yes, there is a range, but I'd say increasingly customers are becoming more and more digitally active.
And I think that can be seen again. This is the beauty of the digital franchise and the digital operating environment in which we're currently participating. If you look at access to our app, I think that our app is generally accessed. I think it's around 30 times a month by most customers, and actually that engagement is significant. In fact, it beats the vast majority of digital channels around there. In fact, I don't think there's any other almost like channels that have the access that we do, apart from maybe some of the social media apps. The only other question which we didn't touch directly was relating to share dealing through Scottish Widows, but I think that we've been made it very clear how actually Halifax share dealing and the whole mass affluent and wealth management proposition is absolutely fundamental to the way that we're going to undertake business and have an enhanced proposition for customers going forward. So very much a key part of the way that we look at both banking and investments. I think that actually that completes all the questions. I hope actually having both Sarah and myself answering has not just enabled us to comprehensively respond to all the questions, but also given a bit of a variety from a voice perspective as well, rather than hearing my male voice going on all the time. So hopefully that's provided a bit of a balance and a bit more interest to you as well. But thank you very much indeed for dialing in. I hope it's been useful, and I think, Mike, you wanted to just conclude.
Yes, thank you very much, Douglas and Sarah. It was a great double act. You handled it all very well. I didn't think we were going to get through all those questions in time. I was watching the clock ticking down, but it was perfect timing. So well done. Quite a variety there as well, wasn't there? Anyway, yes, thank you. And do come along again and update us with more news as and when you've got the opportunity. We'd love to hear from you and love to see you both again in the near future. And for the rest of it, have a good evening.
Great. Excellent. Thanks very much.
Thank you very much.